Hey, it's Joe Crump. The next question that I get a lot is, should I set up a Roth IRA for my business? And there's some reasons to do Roth IRAs. I love them. I've got a good deal of my real estate has gone through my IRA because there are two types of IRAs. One, and these are retirement accounts. The first one is before tax money. That means that you can take money that you earned and you don't have to pay taxes on that money, but you can put it into your IRA and let it make money there. And then when you retire, you can pull that money out, but you have to pay taxes on it as you pull it out. So whatever money that made, when you pull it out, you pay taxes on that income that you make after retirement. A Roth IRA is different. It takes money after tax money. So you've already paid taxes on this chunk of money that you're putting in. You put it into the Roth account, and then you can make money on that Roth account until you retire. And then when you retire, you can pull that money out, but you don't have to pay any taxes on it when you pull it out. And that's the beautiful thing for us as creative real estate investors, because what we can do is we can take a very small amount of money. Let's say we only put $1,000 of before tax or after tax money into the Roth. We can use that money as option money to buy other rental properties. So we can buy the rental properties and then we can put tenants in them, and then we can turn around and sell them, which is what basically what I did. I kept them as rental properties, but then we'd eventually sell them off and then buy more properties and more properties over time. The thing is, it does have to be rental properties that you're buying. But it's a great way to build a retirement account and be able to get money out tax-free at the end of it when you retire. The big caveat here is when you have money in a retirement account and you have houses in a retirement account and you have houses outside a retirement account, sometimes the houses outside the retirement account may need more cash, need more cash flow, and you've got the cash flow inside the retirement account, but you can't get it out to the properties that you need it in. And so that can be sometimes an interesting balancing act. I always try to put as much money into the retirement account as I can so it'll be there when I retire, but I also want to have a good lifestyle and I want to be able to live with what I'm doing out here. I also, when I buy subject to properties, which you can also put into a Roth, by the way, because the loans are non-recourse loans, and you can put non-recourse loans into a Roth IRA. Of course, you have UBIT tax, so you have to pay attention to that, UBIT. You can look that up on Amazon. I won't get into that. But you can take your subject twos and put them in there. But most of my subject twos I've kept outside my Roth because I can also depreciate them. So I can use those investment properties to depreciate my regular income so that I pay less taxes every year. And when I have $100,000 worth of deduction or $100,000 property, I can deduct that over 27 and a half years. So that works out to 3.64%. So let's say on a $100,000 property improvement, I can get $3,600 off. So if, for example, you made $100,000 that year, you wouldn't have to pay taxes on $3,600 of it. And if you're in a 30% tax bracket, that means you just made $1,200 on tax benefits of owning rental property. And if you have a bunch of properties, this starts adding up really quickly. So it's something that's worth doing. All right, I hope that helps.